You're well known, Brian, for being a value investor. For those who are unaware, what does that mean? What does it mean to be a value investor?
Sure. So there's two broad categories that investors get broken up into: growth investors, value investors. And I actually wouldn't consider myself to be a quote unquote value investor. If you had to assign a label to me, I would consider myself a growth investor. But as Warren Buffett points out, those two things are really the same. If you are, all intelligent investing to a degree is value investing. You're paying less for something today than you will think it will be worth in the future. Period. I mean, that's investing. Nobody is going to purposely pay more for something today that they think will be worth less in the future. The only way that you would do that is if you betting against that stock or that equity. So all investing is value investing. It's saying this thing that I'm buying today will be worth more, significantly more potentially, in the future. The tricky thing is when you talk about value investing, classically, value investing looks for businesses that are statistically cheap. Maybe they have a price to earnings ratio of 5. Maybe they're trading below their book value. Maybe they have more cash on their balance sheet than their market cap. Although that situation doesn't really happen all that much anymore with modern computers. But that's kind of like traditional value investing. And to a
Yeah.
lot of traditional value investors, the idea of saying to them, hey, this stock is trading at 35 times earnings, it's cheap. Like that just doesn't compute to them, because you'd say, no, that stock is 50% more expensive than the average company in the market. It's not cheap. It's fully valued. But if you look at some of the stocks that I own and I purchase, many of them are trading for insane valuations. They're trading for 1,000 times earnings, or they're trading for 15, 20, 25 times sales. And believe it or not, I would argue that many of those are value investments, in that I believe that the future market cap or the future value of that company will be significantly higher in 5, 10, or 20 years than it is today. Therefore, even though I'm overpaying for those companies right now, I'm going to argue that they're actually a quote unquote value investment, just not viewed through the traditional lens.
Okay. Okay. Interesting. Interesting. Because one of the questions I was going to ask you is, do you think value investing is still relevant? So based on your explanation just now, do you think the way that we've come to know value investing to be, is it still relevant now?
Yes, totally. There are plenty of investors out there that can look at the markets and say this thing again is statistically cheap, and for the following reasons, it's going to rise in value over time. If you look at that style over the last 10 years, it's been a horrible place to put money. Things that were cheap have stayed cheap for 10 years. Even big, durable, dependable companies. But I don't think that value investing, quote unquote, traditional value investing is dead. I just think it's getting harder in a sense. The reason that it's getting harder is there's so much innovation that's happening in the world today. So much innovation, so much disruption. And when one of the big trouble spots that you can get into with a traditional value investing is to say this business is statistically cheap, and that doesn't make sense because this business will bounce back or whatever. However, if that company's business is rapidly heading towards zero, if the revenue and the profits are rapidly heading towards zero because of some disruption that's in the market, that's when value investing can really get you into trouble, because things that are cheap can not only stay cheap, but they can get cheaper as the earnings of that company, earnings power of that company decline rapidly. You could have made a very compelling case to a lot of investors that Kodak was dirt cheap in 2002. Like, statistically, it was dirt cheap. The problem was digital cameras were going to wipe out its business. So if you ever looked at Kodak and said, on a price to sales ratio, cheap; on a price to earnings ratio, cheap; on a price to free cash flow ratio, cheap, didn't matter. The business was disrupted. So that's where value investors can get into trouble. However, I still think that there is value investable principles that can be applied. You just have to be super, super careful that you're not buying something that's about to be disrupted.